Andrew, it's great to have you because let's rewind to last night. You guys are expecting a half-point rate hike by the Fed next month. Okay, then we get this morning's terrible consumer sentiment report. We've got the flattening yield curve. We have a potential imminent invasion of Ukraine. What happens now?
Yeah, thanks for having me on, Kelly. I mean, as we see these headlines, it just kind of emphasizes for me what inflation means for the Fed and how different monetary policy is in an inflationary environment. And we're used to Fed policy that can react to any shock, any bump in the road. So you have some external concern about growth, you have some volatility in financial markets, and the Fed can step in and react. And the issue that you have with inflation is that now there's a constraint. The Fed needs to move to try to head off this higher inflation.
This is a really important point, and feeding that constraint is the upward move in energy prices right now. So, you know, oil's where it is. Who knows what's going to happen with natural gas now in the coming weeks? And that adds to the upward pressure on inflation. Andrew, again, where does this leave the reaction function? So would you guys, with everything that we've just outlined, still expect a half-point rate hike next month? And what happens if they blink and they don't do that?
I still think they will take that half-point rate move. And the reason is partly because of what you asked, because what happens if they don't do this? This is something that's becoming increasingly expected in the market. It really got fairly fully priced in yesterday. Maybe we're backing off of that a little bit today. But the issue for the Fed is when we're in a world where headline inflation is running above 7%, core monthly inflation, if I annualize it, also at or above 7%. If you back away from any kind of expected hawkish policy or normalization of interest rates, the question that markets will ask and the question the public will ask is this Fed serious about fighting inflation? And I think that's what we're hearing from Fed officials. Maybe they're not endorsing a 50 basis point move, but they're not taking it off the table. It's being left on the table. So I think it's just very hard at this point for Fed officials to not start normalizing and not start normalizing pretty aggressively.
Yeah. Andrew, just with one final comment, if you could, does this up the odds that the U.S. could enter a period of sluggish growth? I mean, do we start talking stagflation?
Right. So, of course, what the Fed is trying to achieve here is some kind of a soft landing. But it's a soft landing coming down from pretty high, pretty elevated inflation rates. So that's certainly what they're trying to achieve. Can they kind of slowly move up interest rates, slowly add some restraint to the economy and bring inflation back down? I think that's still an available path, but the probability of that path is probably going down a bit. And we're starting to raise the probability of a more significant tightening of financial conditions and a more significant slowdown in growth.
So you wouldn't quarrel necessarily then with what we heard Jeffrey Gundlach say about 2 hours ago with Scott Wapner out in Los Angeles, where he said he was seeing increasing signs or mini signs of possible recession.
Yeah, I think it's maybe a little bit premature to be talking about recession. I'm not sure if I'm seeing those signs in the data for a recession now, but when we look at something like the yield curve, it's a forward indicator for some probability of recession. And so where I would agree is that probability is rising.